Hello, everyone, and welcome to today's NOVA presentation, Plan Design Futures to Consider for 2026, hosted by our very own David Thorogood and Jonathan Cruz. Before we dive in, I want to point out the question mark icon at the top of the webinar screen. While that's typically where you submit questions, we won't have time for a live Q&A during today's session. If you do have questions, please reach out to your dedicated account manager or email us at webinars@nova401k.com, and I'll make sure your question gets to the right person. Right next to the question mark, you'll see a paper icon. That's where you'll find the handouts for today's webinar, including a PDF of the presentation. If you're unable to view or download it, just send us an email and we'll make sure you get a copy. If you're joining us today for continuing education credit, please make sure to stay until the end and complete the pop-up survey. This helps us track your participation. Certificates will be emailed within a week to those who meet the time requirement. To catch up on any webinars you may have missed, including the recording of today's session, you can visit our YouTube channel, Nova 401k Associates, or head to our website at www.nova401k.com/webinars. Thank you so much for joining us. I would like to now introduce today's presenters, Senior Account Managers David Thorogood and Jonathan Cruz, who will be leading us off.
Thank you, Ava, for the introduction, and welcome everyone to today's webinar presentation to discuss plan design considerations for 2026. As Ava mentioned, my name is Jonathan Cruz. I'm a Senior Account Manager here with Nova, and happy to be here with you today. Next slide, Ava. So before we jump into the content of the presentation today, I just want to make mention the information in this presentation is general in nature, not intended to be a substitute for legal or tax advice. Please consult a qualified professional, such as an attorney or an accountant, if you do find yourself in need of any legal or tax advice. Next slide. For those attending today needing CE credit, as Ava said, you'll receive your certification within 1 week after the completion of this webinar. So on the agenda today, we will discuss the current limits for the 2025 plan year. Under the umbrella topic of plan design considerations, we will discuss subtopics pertaining to eligibility, match and profit sharing contributions, automatic enrollment, safe harbor 401k plans, and Roth. And within each of these topics, we will hone in and discuss the impact to retirement plans, plan sponsors, and participants alike. Next slide. Some of the learning objectives today, to discuss the reasons certain changes in a qualified plan will be taking place, to identify various plan design considerations and the impact that they will have on plan sponsors and participants, and to understand the process and the timing for the implementation of certain changes and everything involved in that process. Next slide. Okay, why are changes to the retirement plan industry important to discuss and consider? First and foremost, impact to plan participation. Changes made to plan design can directly impact the participant, your employee demographic, those that are participating into the plan, utilizing the plan. And so you always just want to be aware and have this kind of as a beacon, in your thought process when you're thinking about making any change to the plan. How can I optimize the plan? How can I make this better for my employees, for my plan participants? Economic uncertainty. It's important to know when certain changes are being made within the industry, whether they're mandated, perhaps self-directed by the plan sponsor, how they'll play out within the current financial climate that we're in. The market can, in some cases, directly or indirectly, impact a retirement plan via investment offerings, etc. So it's just always good to be aware of the financial climate that we're in when making any changes to your plan. Regulatory changes. It's always also good to be aware that of any new regulations that have rolled out that you need to just kind of be aware of and make sure you're accommodating when you're making any change to your plan. You want to make sure that you're compliant always, and to that end, you have your service partners that you work with, namely your TPA like Nova or your record keeper, to work with them, have the conversation with them just to make sure that not only are you optimizing your plan, but you're being very compliant with your plan as well. Vendor system automations. Again, working with your partners, your service partners, um, having the conversation whenever you're making a change to your plan or when there's a mandated change to your plan, you want to make sure that the partners that you work with, your record keeper, your TPA, that they're set up and they're equipped to accommodate whatever the specific change is that's being implemented. So whenever you're having these internal conversations about making a change, make sure that you're including your partners just so that you're sure that everyone is equipped to handle the change. Recruiting and retaining talent. So one of the motivating thoughts, I think, from a plan sponsor perspective when making changes to a plan, you always want to optimize your plan, make it more attractive. And one very good reason for that is it's a great recruitment tool. It's a great retention tool. The more attractive your plan is, the better chance you have of getting that new hire over the other company, or the better chance you have of retaining the employees because of the attractive retirement plan that you have. So it's always good to look at when making changes to your plan, to look at it through that lens, just to make sure that one, you're optimizing your plan and you're providing the best offering that you can to your employees for the purpose of recruiting good employees and also retaining good talent as well. And that provides added value and a greater benefit at retirement for all your participants. Next slide. Okay, the current 2025 limits. So for a 401k plan in 2025, the annual deferral limit is for an employee not 50 years of age, under 50 years of age, is 23,500. That's the annual deferral limit, the max that you can contribute. If you are age 50 or older, you are able to contribute on a catch-up basis, which would mean you can contribute an additional 7,500. So that would maximize and cap your annual deferral at 31,000 for the year. So I just want to throw this little caveat out. For those over 50, but ages 60 to 63, you are actually eligible for the super catch-up. So that's 150% of the standard catch-up amount. So instead of 7,500, you'd be able to contribute an additional 11,250. So just kind of backing up for a minute, just to show the distinction here. In 2025, for those under 50 years of age, the annual deferral limit is 23,500. If you are age 50 or older, but not 60 to 63, you can contribute an additional 7,500. And for those ages 60 to 63, you are entitled to catch up on that super catch up basis, which would mean you can contribute an additional 11,250. The 415 annual limitation for the 2025 plan year is 70,000. Now this is the sum total of all contributions into the plan, not just employee deferrals. This is all employee and employer deferrals. It's 70,000 plus whatever catch-up bracket you find yourself into. The limits for 2026 have not yet been released. I'm sure most, if not all, here today have seen projected limits, but the definitive limits will be released sometime this year, probably around October or November. Next slide. Okay, changes to plan eligibility, specifically LTPT, also known as long-term part-time. In 2025, several key eligibility-related provisions from Secure Act 2.0 did impact retirement plans, particularly in how employers handle part-time workers and new plan designs. Here are some of the most notable changes. Expanded eligibility for long-term part-time, LTPT workers. In 2025, employers had to allow LTPT employees to participate in their plan if they worked at least 500 hours per year for 2 consecutive years. Now, you might remember that Secure Act, the original Secure Act, it was 3 years where you needed to work 500 hours, 3 consecutive years. In Secure Act 2.0, this was reduced down to 2 years. This rule applies to 401k and 403b plans that are subject to ERISA. Next slide, please. Okay, LTPT continued. Some important notes. Employers are not, I repeat, not required to make matching or non-elective contributions for LTPT employees. This change is especially impactful for industries with large part-time workforces, for example, retail and hospitality. So for those of you joining today, if you are in any of those industries, you might just want to highlight and make note of this part of the presentation, as this might be impactful for your retirement plan. Some impact on employees. Well, you have increased retirement savings opportunities for part-time workers who may have been previously excluded. More access to retirement benefits in general for the overall workforce. Next slide, please. Impact on employers. There can be increased administrative complexity. I say this because, with having to track the hours over multiple years, that creates a little bit more of an administrative burden for the plan sponsor to make sure that they have a mechanism in place for all this tracking. Plan document updates, like with any change or any newly added provision, within your plan, there likely is going to be plan document updates that need to be made, amendments made. You have your service partners to work with on this, namely Nova, like as the TPA. So just be aware, anytime there's any new development within retirement plans that may impact the structure or the provisions, the plan document likely has to be updated. So just something to be aware of. And as I mentioned before, no matching or non-elective contributions are required by the plan sponsor. So for LTPT employees, again, I'll just highlight this fact. If deemed to be an LTPT worker, the employer needs to allow participation in the plan, but employers are not obligated to make employer contributions. And this can help manage costs, from a budget perspective. Next slide, please. Changes to plan eligibility, mandatory automatic enrollment for new plans. Although this provision took effect in 2025, its impact will be felt more broadly in 2026 as more new plans are established. Some key points include: this applies to new 401k and 403b plans established after December 29th, 2022. So when I say established after December 29th, 2022, I just want to highlight this means that your plan document, your adoption agreement, was signed after that effective date. If your document was signed after that effective date, you would be considered a newly established plan that would fall under the mandatory automatic enrollment provision. So mandatory automatic enrollment, it requires a minimum of a minimum default contribution deferral rate of 3% of pay. If you do the 3%, then you do need to have an escalating feature. So annual escalation of 1% each year until reaching a maximum of 10%, not to exceed 15%. A plan may set the default auto enrollment rate at 10%, which would negate having to have an auto escalation provision at all. So I just want to make note here that although there are some specifics within the mandate as to what an employer needs to do to satisfy the mandatory automatic enrollment, there is some discretion there as to how you want to roll that out within your plan. Like I said, you can set a lower default percentage and have an auto escalation feature until you reach that maximum 10%, or you can start your plan out with the default at 10% and negate having to have any auto escalation at all. Some exemptions to mandatory automatic enrollment are employers with 10 or fewer employees, employers less than 3 years old, or certain church and government plans. And what I would say to this end, if you are a new plan, and let's say you do start off and fall into one of these categories, it is at your discretion to defer having to adopt the mandatory automatic enrollment. But if you know that in a year, 2 years, you will fall into the category of no longer being an exemption, you may just want to out of the gate, just start your plan with the mandatory automatic enrollment, knowing that you'll have to do it at some point down the road anyway. Next slide. Okay, mandatory automatic enrollment continued. Impact on employees. So you have higher participation rates, especially among younger or lower income workers who would not maybe necessarily enroll on their own. You work towards the optimization of the retirement plan, improved long-term savings, and the flexibility remains. Employees can opt out or change their contribution rate at any time. And for those employees that do not opt out prior to deductions being taken, prior to being auto-enrolled, most plans have a 90-day permissible withdrawal option. This option allows for employees to have their contributions refunded back to them within a 90-day window. Next slide. Impact on employers. The higher plan participation, good for employee savings. It may also increase employer costs just from the perspective of employer matching contributions. Obviously, the more employees you have contributing, the more you would have to give in terms of your employer match. So something to consider. Also, system and payroll updates. Plan sponsors, employers need to be sure that their systems, payroll, all of that, are set up to handle auto enrollment and or escalation and all the necessary updates that come with it. So there's some work on the plan sponsor here, on the plan sponsor side, to make sure that they're set up on their end, but also working with your service partners, your TPA, and your record keeper, they'll assist you in this regard as well. And better ADP testing results. So mandatory automatic enrollment, it is very favorable for your non-discrimination testing. The more participation you have in the plan, the more favorable results you'll have for non-discrimination tests. Next slide. Why should plan sponsors amend eligibility provisions? Well, for one, compliance with new laws, and like we've been discussing, specifically Secure 2.0. We've talked about LTPT and automatic enrollment. We talked about talent attraction and retention. Shortening eligibility periods can make a plan more attractive to new hires. This is especially valuable in competitive labor markets or industries with high turnover. And to discuss some of the workforce demographics, employers with a large part-time or seasonal workforce may want to include more employees to promote financial wellness. They may also want to limit eligibility to manage administrative costs. So some just dynamics there to consider. Next slide, please. Simplification and administrative efficiency. And a plan sponsor may want to align eligibility rules across multiple benefit plans, standardize their eligibility across various business units if they do have multiple business units. And like I touched on, plan testing and non-discrimination. Adjusting eligibility can help with non-discrimination testing, including more non-highly compensated employees can improve test results and reduce the need for refunds to highly compensated employees or other corrective measures that may be necessary if you do fail any non-discrimination testing. Next slide, please. Changes to employer matching and profit sharing contributions. Some important impacts to matching and profit sharing contributions in retirement plans to consider in 2026, primarily due to Secure 2.0. Here are some key updates to consider. Optional Roth employer matching and profit sharing contributions. Employers will be allowed to offer matching and profit sharing contributions on a Roth basis rather than just the traditional pre-tax basis. This means that employees can choose to receive employer contributions as Roth, which would be on an after-tax basis. These contributions will be immediately vested. I just want to say that again and highlight that point. These contributions are immediately vested. Although this provision was introduced back in 2023, many record keepers delayed implementation pending IRS guidance, so broader adoption is expected in 2026 and beyond. Next slide, please. Okay, some implications to just think about. Tax-free growth. Employer match and profit sharing contributions that are made as Roth will grow tax-free and will also be tax-free when distributed. Highlighting the point I just mentioned, immediate vesting. Roth employer contributions must be 100% vested immediately, and this benefits employees who may leave the company early. Higher taxable income. Roth employer contributions are taxable in the year received. And just an important note to consider, especially with an ever-changing financial market, it is always practical and prudent to consider the influence of inflation adjustments as well as regulatory changes that may impact employer contributions. Next slide, please. Okay, so we're going to discuss a little bit on matching on student loan payments. So this initially became effective back in 2024. Employers can treat qualified student loan payments as elective deferrals for the purpose of matching contributions. This allows employees who are paying off student loans as opposed to contributing to their 401k to still receive the benefit of employer matching contributions. Why it matters in 2026? Well, again, adoption is expected to grow as more employers recognize this as a recruitment and retention tool, especially for younger workers. Next slide, please. Benefits for employees. Diversified tax strategy. Having both pre-tax and Roth sources in a 401k allows for tax diversification, giving retirees more flexibility in managing taxable income. Again, the immediate vesting requirement. Roth matching contributions, 100% vested immediately, giving employees full ownership right away. Next slide, please. Benefits for employers. Attractive recruitment tool. Roth Match can appeal to younger, financially savvy employees. It supports financial wellness, encourages employees to think about long-term planning, which can improve overall financial literacy and engagement. No additional cost from a structural standpoint. The amount of match doesn't change, only the tax treatment does. Employers don't pay more in contributions, just potentially in payroll tax. Plan differentiation. Offering Roth matching contributions sets a plan apart from competitors, especially in industries with high turnover or skilled labor shortages. And I think this is an important point to highlight, plan differentiation, because it goes a long way. Again, we were talking about recruitment and retention. When you differentiate your plan in a way where your plan stands out because of the betterment of what you offer, the attractiveness of what you offer, it goes a long way to getting those new hires and to retaining the staff that you have. Optimization is always the goal. Next slide, please. Benefits for oh, sorry. There we go. All right, Safe Harbor 401k plan. So thank you all for listening to me. I appreciate your time today. I am going to go ahead and give it up to my colleague here, David, who's going to take it from here. David, you want to jump in?
Certainly. All right. Well, thank you, John. I appreciate it. And thanks, everyone, for joining. I appreciate very much you being here. We're going to go over some of the basics of safe harbor plans. All right. So the concept of safe harbor provisions within a plan emerged as part of the Small Business Job Protection Act of 1996. The important thing, one of the greatest benefits of the safe harbor plans that came out was the IRS realized that a lot of plan sponsors, especially small businesses, were having a difficult time in the regulatory environment as far as passing testing requirements, which we'll go over later. And as a result, they came up with the safe harbor so that it would allow small business owners, the owners, and the highly compensated employees of those plans to be able to contribute to those plans and make it worth their while in order to offer the plans to their participants and also increase their retirement savings and give their participants the chance to do that as well. So in 1998, the IRS released guidance that allowed for the creation of the safe harbor plans. And then in 99, the safe harbor contribution formulas became available for most plans. Now, the IRS continues to provide additional safe harbor types of guidance, such as the introduction of the QACA match, Qualified Automatic Contribution Arrangement. There's a lot of acronyms in this business, and that'll be discussed later. And also having the ability to discontinue safe harbor contributions mid-year, which is a big benefit to a lot of employers. Next slide, please. Benefits. Well, avoids refunds at year end for highly compensated employees when the ADP test or the ACP test is failing, including limits on the HCE 401 contributions. because if they failed the ADP or ACP test and received refunds, it's not near as egregious as it used to be. It used to be a horrible thing because in the past, the IRS mandated that if you received a refund in 2025 for the deferrals you made in 2024, the tax on that refund was payable for the 2024 year. And the refunds did not have to be made until March 15 of the following year. So you had a situation where highly compensated employees were having to go back and amend their taxes. And so it was very egregious. Since then, they've changed that, which is much nicer, but still people do not want refunds. In addition, it satisfies the top-heavy requirements, top-heavy being a plan that if 60% or more of the assets are held by key employees, owners, and officers making above a certain salary, have more than 60% of the assets, then an additional contribution would have to be made to the plan on the behalf of the non-highly compensated employees. There are exceptions if there are some types of profit-sharing contributions that exceed particular limits. It also could satisfy the contribution requirements for new comparability contributions, which is a type of profit-sharing plan or cross-taxation plan, and it's the minimum gateway feature. And we'll talk about that coming up in just a bit. Next slide, please. What are the cons? Well, a safe harbor contribution, regardless of the type, is a required contribution. Now, I mentioned that fortunately, the IRS has mandated that companies that are suffering an economic hardship can rescind that safe harbor contribution mid-year. This wasn't the case not too long ago. But with this, if they do that, they are subject for the ACP and ADP testing for the entire plan year. So there is a penalty for doing that, but at least they have the option to do that if they're experiencing economic hardship. Safe harbor notice must also be made to all participants if matching contributions must be provided. That's right, another notice. I know there's a bunch of notices that go out, but this is just an additional notice. But for instance, John talked about automatic enrollment, but the safe harbor notice can also be included with the automatic enrollment notice. Now, safe harbor matching and non-elective contributions are immediately 100% vested, with the exception of QACA matching contributions, which we'll cover here in just a little bit. And while the safe harbor match is required for everyone who contributes to the plan, the safe harbor non-elective is required for all eligible participants. And that's very important during plan design that that's explained to the plan sponsor so they understand that. Sometimes you'll find that they say, yeah, just give me the safe harbor non-elective, make it simple. But sometimes when they find out that you're giving money to a participant who doesn't even make a contribution, sometimes they're not very excited about that, don't like that, and they want to change it. So there's a give and take for that particular benefit they get. Next slide. What are the types of safe harbor contributions? Well, there's the non-elective I mentioned. Non-elective contribution is 3% or more of compensation, regardless of how much the employee defers, as mentioned. So 3% or more of all eligible participants. The basic match, which is 100% of the 3% of compensation and an additional 50% of the next 2% of compensation, which is 4% compensation total. And then there's the enhanced match, which is basically must equal or exceed the basic match at each tier, can't be less than the basic match. And a very common enhanced match is 100% on the first 4% of match. So the basic match, if you defer, in this case, 5% of pay, you're going to get 4% of compensation. You're going to get a 4% match. And that way, if you defer 4%, you're going to get an enhanced match. You'll get 100% of those 4%. Next slide. All right. Types of safe harbor. Okay. Qualified automatic contribution arrangement, QACA match. This is for matching plans with the automatic enrollment feature. The basic formula is 100% of the first 1% of compensation a participant defers, plus 50% on the next 5% of compensation they defer, totaling a 3.5% of compensation in total. The basic QACA match is attractive to plan sponsors because the QACA 3.5% match is actually less than the basic match, but you still get the same benefits of being safe harbor. You get a pass on the ADP ACP test, and you get a pass on the top-heavy test. And this actually is more benefit because if you look at the QACA match, it's 3.5. The basic match, if someone contributes 5% of pay, is 4% of pay. Let's say you have a very large payroll, and 0.5% of a very large payroll could be a pretty significant number. The biggest thing is, unlike other safe harbor contributions, the QACA match can be subject to a 2-year vesting schedule. So you have a company with a high turnover ratio, sometimes the 2-year vesting schedule can be very attractive, but without turnover, they're not vested. Those funds that you make the match for, they go to a forfeiture account, and the plan can use those to offset future contributions. Next slide, please. Additional safe harbor benefits. Okay, we talked about this earlier, new comparability or cross-tested profit sharing plan. So one of the tests involved with the new comparability profit sharing is the minimum gateway test. And basically you have to have 1/3 of the average percentage of the HCE's ratio up to 5%. So whatever the average percentage that the HCE receives as a profit sharing plan, the non-highly compensated employees have to receive at least 1/3 of that match, of that amount. Now, the safe harbor non-elective actually goes towards satisfying this minimum gateway. So if the average contribution that the HCEs receive is 12%, then the required gateway minimum for the non-highly compensated is 4%. So with the 3% non-elective, it actually satisfies 3% of the 4% required in order for the test to pass. So the employer would only need to contribute an additional 1% of pay. So from a design standpoint, if let's say the owners, the HCEs, they want to get the maximum profit sharing they can, then the new non-elective contribution really adds an added benefit to them. Not only do they get a pass on the ADP, ACP test and the top-heavy test, but it also satisfies what they would have to make towards profit sharing irregardless in order for them to max out their contribution. Next slide. Flexibility. Can a plan make discretionary matching contributions in addition to safe harbor match or non-elective contributions? Yes, they can. Well, why would they want to do that? Well, let's say, for instance, a company has a banner year. They're loaded with cash. They want to make additional profit sharing or additional matching contributions to their participants. They really value their employees. Can they do that? Certainly they can do that. But there's some conditions. There's some limits. IRS is very good about setting limits on things. Okay, so the match cannot be based on more than 6% of deferred compensation. Now, when I say 6%, based on more than 6% of deferred compensation. So you can have a matching formula, which is discretionary. And you could say, all right, I want the match formula to be 50% up to 6% of pay. You could do that. You can't say 50% up to 8% of pay, but 50% up to 6% of pay, which of course will be 3% of total. Now, the second bullet we talk about, a discretionary match cannot exceed 4% of compensation. That's 4% of compensation, but that's the total. And it's not necessarily what it's based on, but that's the total amount that they receive on their compensation. And this particular match rate cannot increase as elective deferral rate increases. So if you have someone that's deferring 4% of pay, they have to get the same match that someone gets if they defer 6% of pay. It can't vary. Now, the big point here is that for a discretionary match, the match can't be subject to allocation conditions. For safe harbor matching contributions, there are no allocation conditions. An eligible employee who receives a safe harbor match, you can't put an hour requirement on how long they work during the year, and you can't have a last day rule. And so for some employers, this is not deemed as something they really want to do. they need to really think twice about during the plan design, because if someone leaves for the end of the year and they're terminated at the end of the year, and then come after the end of the year, if they want to make additional matching contributions, and they have to make a match for John Doe who quit in August of the year before, sometimes they're not very excited about doing that, but they have to do it in order for it to be a valid contribution. All right, next slide. All right, now we're going to go into Roth contributions. So, where did Roth come from? That's the question. And why is it called Roth? Senator William Roth from Delaware in 1997 introduced legislation into Congress to create the Roth IRA. So it was after Senator Roth where we got the name Roth. So for you trivia buffs, now you know where Roth came from. So in 2001, EGTRA introduced the Roth 401 contribution. In 2006, the Pension Protection Act made the Roth 401k provision permanent. Now, Secure 2.0 is the latest act signed into law, which introduced employer Roth contributions, which John talked about earlier, and we're going to discuss some little further detail coming up, and Roth catch-ups for high earners, which is going to be a big topic coming up in 2026. Next slide. Fundamentally Roth. All right. So defined contribution plans can allow participants to designate all or a portion of elective deferrals as Roth after-tax contributions. So that means that you can designate a portion of what you defer as Roth, but you don't have to designate all as Roth. So let's say you wanted to contribute 6% of pay to a plan. You can make it 3% pre-tax and 3% Roth. You could do a combination of both. Roth contributions must be segregated from pre-tax contributions. This is the big reason for this is Roth has a basis that must be carried. We'll talk about that coming up. Very important to know for plans that have brokerage accounts. It's very important that those plans have separate individual brokerage accounts for the Roth portion for an individual and a pre-tax portion for the individual. You can do a single brokerage account, but the trust accounting involved can be very cumbersome. It can be very expensive for a plan sponsor, and you're subject to errors. The more times, the more pen and ink you put on something or pencil or paper, the more errors you're going to have. But it's just much easier to have separate accounts for Roth and for pre-tax. Now, Roth contributions, although they're made in a 401k plan, they're after-tax dollars. They're not tax deductible to participants. And they're not in box 12 of the W-2, and they're not deductible. Important thing, Roth contributions are not the same as after-tax contributions. And we're going to talk about that now. Next slide, please. All right, is it Roth or is it after-tax? All right. Although both contributions are made with after-tax dollars, there are significant differences. Investment gains on after-tax contributions are taxable at the time of distributions, where investment gains on Roth contributions are not taxable if the 5-year rule is met. We'll cover the 5-year rule in a minute. After-tax dollars are not subject to the annual 402G deferral limit, which is $23,500 for 2025, $31,000 with catch-up. But it's subject to the annual 415 limit. The 415 limit being the total amount of contributions that a participant can receive in their plan for the total plan year. So it's $70,000 for 2025, $77,500 with catch-up. And unlike Roth contributions, after-tax contributions are not deferrals. After-tax is a contribution. It's not a deferral. And they're subject to the ACP discrimination test. And that's a big deal because there was a big deal that came up not too long ago called Mega Backdoor Roth. And so the investment advisors got wise and they said, okay, here's what we're going to do. because IRA Roth at the time, the limit was $8,000 you could put in it. And they thought, wow, well, we can put, at the time, I don't remember the limit at the time it came out. But let's say if you could put $70,000 of after-tax money in a 401k plan, and after tax money, you can roll out at any time. So they put $70,000 of after-tax money in the 401k plan, and they'd roll it over into the Roth IRA. That was a great way to get more money into the IRA so they could have it as Roth. Problem is, if passing the ACP test. So let's say you have a plan that has 10, 15, 20 people in it, and it has a minimal match, and you have an owner that has $70,000 in, which goes towards the match, the ACP actual contribution percentage test. It fails miserably. They get it all refunded to them. So it's all for naught. All is lost. So it doesn't work. It's great for solo plans, but that's just about it. All right, next slide. And here's just a little side-by-side comparison, Roth and after tax. Taxes on contribution, well, contributions are after tax for both Roth and after tax contributions. Taxes on withdrawals. Withdrawals are tax-free as long as the requirements are met on a Roth 401k plan. We'll talk about those. After tax contributions, withdrawals of earnings, they're taxed as ordinary income. 2025 contribution limits for Roth, as I mentioned, 23.5, 31,000 with catch-up, 77,000, 70,000, and 77.5 with catch-up. Rollovers. Contributions and earnings can be rolled over into a Roth IRA from a Roth 401k plan. After tax, the contribution can be rolled into an IRA, but the earnings have to be converted to Roth, and they're subject to taxation at that time before they're rolled over. Next slide. All right, the Roth 5-year rule. Earnings on Roth are not subject to income tax if the Roth account is not distributed for 5 years. The initial contribution to the account is considered the basis. So all Roth contributions to a specific 401k account will share the same after-tax basis, meaning total of your contributions will be tracked together. So the 5-year period begins on January 1st of the first year the Roth contribution is made. But think about that, January 1st. You have an individual who makes a Roth contribution on November 2nd of 2025. Well, his 5-year period begins on January 1st of 2025. So he gets an 11-month or a 10-month break on when his basis actually begins. All right. If a plan in Roth conversion occurs, a separate basis created on January 1st in the year of conversion for that in-plan conversion. So if he has pre-tax money in a plan and has Roth in a plan, when he does the Roth in-plan conversion, a separate basis is created for that in-plan conversion. Now, distribution to Roth accounts is considered a non-qualified distribution if it's made before 59.5 and the earnings are taxable even if the 5-year period has been met. So no way can you take your money out. If you do, you lose all the benefits of the earnings not being taxable. They're taxable. Next slide. So in-plan Roth conversions. Basic is if a plan allows for in-plan Roth conversions, it must also allow for Roth deferrals. Pretty basic. You got to have Roth deferrals or you can't have an in-plan Roth conversion. And the following participants can elect an in-plan Roth conversion. The actual participants, surviving spouse beneficiary, alternate payees as a result of a quadro. They can also do in-plan conversions. But in-plan conversions can only work one way. Believe it or not, I've heard this before, Roth contributions cannot be converted to pre-tax deferrals. Someone goes down the road and they decide, oh, by the way, I've been putting in a lot of Roth lately and I need a tax deduction this year. So I want to convert my Roth into pre-tax so I get a deduction. No, the IRS is not going to give them the money back. It doesn't work that way. So once converted to Roth, it's always going to remain as Roth. Next slide. All right, employer Roth contributions. Now, John touched on this earlier. The benefit of employer Roth contributions and added benefits. So I'm going to talk about the difficult points of employer Roth contributions. So Secure 2.0 gives the employers the opportunity to make matching and non-elective contributions in Roth. But here are the conditions. The employer contributions must be designated as Roth before the contribution is made. And the participant must be given the opportunity to make an election to designate the contribution as Roth at least annually. Let's think about that from an administrative point of view. For small plans, I could see not so much of a big deal. Larger plans, literally think about it. You've got 200-300 people, whatever it may be, and you have to give them the opportunity annually to make a decision whether they want their match or profit sharing contribution done, whether on Roth, with a Roth or pre-tax. So you're having to get all this information from these individuals. You're having to make sure you have it all documented. You have to make sure you make their contributions correctly. Okay. Another thing to monitor and watch out for. Okay. Employers can't exclude Roth contributions from participants' growth income. Just like employer Roth is the same way. It's included in gross income. And just as Roth deferrals, employer Roth contributions must be held in a separate account. Speaking of separate accounts, we've talked about it. John mentioned it. I mentioned it again. From the record keeper standpoint, it's a daunting task for them to be able to account for this. And I know they're working diligently to be able to accommodate this with the different sources they're going to have to account for. It's a big task. I know they're working, like I said, very diligently to try to get this up and running. So, and here's the big one. Like John mentioned, Roth contributions, employer contributions, 100% vested. And the reason 100% vested is participants have to be 100% vested to designate employer contributions as Roth contributions. And the restriction can be applied separately to each money source. Let's say, for instance, you have a plan that has dual vesting schedules for match and profit sharing. You have a 6-year vesting for profit sharing and a 3-year vesting for matching contributions. You have participant John Doe, who's been there for 5 years. And he wants all of his matching and profit sharing contributions in Roth. Well, okay, he can have the matching contributions as Roth, but he can't have the profit sharing contributions as Roth because it's not 100% vested. So from an administration standpoint, they're going to have to know, is he 100% vested in order to do that? And also the provision to offer employee Roth contributions is optional, and plan sponsor does not have to do it. They don't have to offer it. It'll be a plan amendment issue, which we'll cover later. All right, next slide. All right, Roth catch-ups for high earners. Before I go on to this, our esteemed colleague Craig Hoffman, who's an excellent presenter and an expert on everything ERISA, will also be presenting on this next week. To get into further detail, I'm going to hit the high points on it today. But Secure 2.0 high earners, Secure 2.0 requires, this is not optional, requires high earners to make catch-up contributions on Roth basis. Now, high earners is something different than HCEs or highly compensated employees. Effective for plan years beginning after December 31, 2025. So it's just around the corner. And a high earner is someone that makes over $145,000 in FICA wages in the prior year, subject to cost of living adjustments. So it will be adjusted just like all the other limits that we have. And only compensation from the plan sponsor is taken in consideration when making the high earner determination. And compensation for partial years is not prorated. Next slide. Okay. Catch-up contributions for high earners challenges. Well, first of all, you have to have a Roth provision in your plan where catch-up contributions can't be allowed. You don't have a Roth provision, they can't make catch-ups because there's nowhere to put it. Plan won't allow for it. Very important. In-plan Roth conversions should be a provision in the plan to correct operational failures, although it doesn't have to. You have the option to have the CPA or the company can correct their W-2 at the end of the year as well. That's another option to do that. But that's just something that would make it simpler to see if we catch it and we found it, convert it, you're okay. Payroll companies and softwares need the ability to track this. They need to know, okay, are they a high earner? If they are, especially if you have full integration with your payroll company and your record keeping company, to know that if they do catch up and they go over the 23,000 limit, say for 2025 or whatever it may be in 26, we don't know yet, that whatever portion that is, they actually put that in the Roth source, that they know that to do that. And then annual testing. All right, more census data. I know your plan sponsors out there listening are excited about this. But in order for us to be able to test the plan and make sure that everything has been done correctly, your plan is compliant, we have to check for this. So we're actually going to need FICA wages. So there'll be another column added into the census field to give us FICA wages for the year. That's the only way we have the ability to know what those FICA earnings are to determine if somebody had catch-ups that did not go into the Roth source like they should have. And we'll be reaching out to the plan sponsors with much more information on this soon to come as well. All right, next slide. All right, just a few other things about Roth. All right, for 2024 and later, Roth contributions are no longer subject to RMD rules, which I think is a great thing. Roth contributions are after tax. Required minimum distributions came about because the IRS wants their money. They don't want people hanging on to it forever and they don't get their money. But the Roth contributions have already been taxed. The earnings have not been taxed, and they'll come out tax-free anyway if they meet the 5-year rule, which in most cases people are going to do. If they decided to go Roth, they know the reason why. So they decided not to make that subject to the RMD rules, which I think is IRS did a good one there. So we appreciate that. Now, self-employment participants, they don't have FICA wages. So they're not even considered high earners, and they're not subject to Roth catch-up. Now, if a plan adds the employee Roth contribution provision, it has to be available to all participants, and not just participants who are subject to the high earner Roth catch-up requirements, but it has to be available to everyone. All right, next slide. All right, amendments. Changing eligibility. All right, if an eligibility amendment provision provides for a more liberal eligibility computation period or entry date until an employee becomes a participant, the plan can be amended at any time. When I say with more liberal eligibility computation period, let's say a plan has an eligibility waiting period, you say, of 1 year. And they decide, you know what, that's too long. We're going to make it 6 months. Well, that's definitely more liberal. You're adding a benefit to the individuals, the employees of your company, giving them an added benefit. So you can add that at any time. So you can amend your plan at any time to do that. If the amendment increases the eligibility computation period, the entry date must be amended by December 31st of the year prior to the effective date of the amendment. So that means that if you're going to increase the eligibility period from 6 months to 1 year, you can't do it mid-year. It has to be for the following year. But for those participants who are employed during the year that the initial eligibility period was in effect, that eligibility for those individuals remains in effect. All right, that goes into what we're going to call the anti-cutback rule, which is in the note below. It's IRC section 411 D6. I suggest everybody read it. It's just exciting reading provides guidance on the anti-cutback rule, prohibits plans from sponsoring when sponsors from reducing or eliminating a protected benefit that has accrued. Now, protected benefits are all across the board. There's all different types of protected benefits. It's very broad in the spectrum. But this eligibility is definitely one of them. And when I say about this last bullet point I talked to, that participant who was there during that time they were working and the eligibility was 6 months and they changed it to 1 year, they've accrued that time. And so you can't change it. They still have to be eligible in 6 months. All right, next slide. All right, automatic enrollment amendments. So the plan was established prior to January 1, 23 and does not have an automatic enrollment provision. The amendment to add automatic enrollment can be done at any time. Anything after 23, of course, automatic enrollment is amended with the exception of a few plans with 10 employees or less. If the plan currently has automatic enrollment amendment to add a discretion, if they have automatic enrollment and they want to add a discretionary match, it can be done at any time. And they can also add the QACA match if they want it to be safe harbor. That can be done at any time. Next slide, please. Safe harbor amendments. The deadline to amend a plan to offer 3% non-elective safe harbor provision is 30 days prior to the first day of the following plan year. But a plan can be amended to add a 4% non-elective safe harbor provision retroactively, but it must be done so by the end of the following plan year. Let's say, for example, you have a plan that failed ADP testing or miserably, and the company does not want to issue refunds. Well, they have the option to retroactively amend the plan to add a 4% non-elective and make that contribution for the prior plan year for all those participants. The reason it has to be 4%, the IRS said, well, yeah, we'll let you do that retroactively, but if you do so, you have to make it 4%, not the minimum 3%. So that's the IRS's way of saying, we'll throw you a bone, but yes, you have to add a little bit to it. And to add a safe harbor match provision, just as the non-elective, the plan must be amended 30 days prior to the beginning of the next plan year. Next slide. All right, amending to add plan employee Roth contributions. Okay, Roth deferrals can be amended to add at any time. And having the new higher earner Roth catch-up regulations will make this mandatory for many plans if they want to allow catch-up contributions for high earners. And if a high earner makes pre-tax catch-up contributions, the only way to correct the failure is to have the plan do an in-plan Roth rollover, or like I said, as I mentioned, they can actually have their W-2 corrected or adjusted to make sure that that is done so. And they show those Roth contributions as those pre-tax contributions as Roth. This is why it's another example to check with your record keeper to see if the provision is available on the platform. But the in-plan Roth rollover is certainly the easiest way to do so. All right, next slide. All right, employer Roth contributions. Employer Roth contributions. Deadline amendment plan provision, as well as many other secure 2-point provisions, is December 31, 2026. Now, even though the amendment deadline is later, some plans may be able to implement this feature sooner if your service provider is ready to handle the administration, tracking, and reporting requirements. Let's talk about amendment preparation. It's really important to consult with your TPA, your plan attorney, other consultants. If you want to amend your plan, please do so well before the deadline to amend the plan. A lot of preparation goes into this, a lot of thought, consideration. You want to make sure your plan design is accurate, and you want to give us time, or your TPA time, to make sure that we can prepare the amendment in time. Because in addition to that, for safe harbor plans, participant notices have to go out as well. The notice has to be prepared, and it has to be delivered to your participants no more than 30 days before the end of the plan year. Next slide. All right, reminder, Please complete your evaluation survey, which we sent you via a link via GoToWebinars, and receive a certification via email within 1 week. And next slide. All right. Well, I want to thank everyone for joining today. We appreciate your time. If you have any questions, please contact your manager. And for additional webinars, please visit Nova401k/webinars. Thanks again. Y'all have a great day. Thank you for joining.
Hi everyone, just a quick reminder, click on the paper icon at the top of the webinar to access today's presentation and handout form. If you have any issues, feel free to email webinars@nova401k.com and we'll be happy to send it your way. We did not have time for questions, but we will get to all your questions. If you do have any additional questions, send us to webinars@nova401k.com or reach out to your account manager. To catch up on any past webinars or to watch a recording of this one, you can find us on our YouTube by searching Nova 401k Associates. Again, a big thank you to David and Jonathan for today's presentation, and thanks again to everyone for joining us today. We hope you have a great day.